Watch this so you don't let emotion get the better of you when investing. Investing can be a very interesting topic and one that psychology can impact you significantly without you even knowing it. And today we're going to look at a few different things which you should bear in mind when investing. So first and foremost, we have confirmation bias. This is basically the concept that you tend to look for things which align with the views and the opinions which you hold. So this can be very, very dangerous when investing because obviously you're giving away your money, you're investing your money with the expectation of return. In order to be a good investor and in order to make solid, sound choices, you have to do research and you have to find appropriate stocks, or you have to look at different index funds and the things which you think are going to make you a better return in the future. Now, as part of this research gathering process, of course, there's so much information out there and it's up to you to determine which is the most important data to allow you to make a sound financial decision. Now, when building up a case on whether to invest in something, obviously in order to make that initial investment, you have to have enough evidence to say this is going to be a good investment for me. Obviously, you're trying to get evidence which is going to support your argument in that this is a good investment. And if you innately in your mind believe that it's a sound investment, then you're going to look for evidence which is going to support that, and you may ignore evidence which goes to the contrary. This can be very dangerous because you get a very much roses are red and all things are sparkly, sunshine, rainbows, and you don't get any evidence to the contrary. So this can mean that you pick some bad investments to yourself, which could be losses down the line. So it's obviously very, very good to seek the opinion of others. But again, this can also be dangerous because especially when you kind of find, like, for example, if you're on Reddit and you look at investing, there's lots of investment groups for specific types of investors, like dividend investors or like cryptocurrency or ETFs or just general investing. And if you find a group of people whose values all align, it's easy to kind of not form a cult almost, but like you form the opinions and you all kind of bounce off each other. And because of that, you get,
oh, this stock's amazing, this stock's amazing, this stock's amazing.
And then you negate the fact that there is evidence to the contrary. So in order to get rid of confirmation bias, actively look for research that goes against what you're looking for. So if you believe that a certain stock or a certain ETF or an index fund is going to rise in the future, look for evidence that says it is not going to rise. Look for the evidence that says it's going to crash. Look for the evidence that it's terrible. And then you can validate whether you think this is correct or not. Do a load of research before you make any investment choices. If you need to seek financial advice, then obviously do so. The second one here is loss acceptance. Now, accepting a loss or accepting that you've picked a bad stock or that the research that you've done can be a bitter pill to swallow because it goes against your morals, it goes against that confirmation bias, but it is important to see that you have accepted a loss and that you're open to new information. For example, if something new that develops comes out and goes against your opinion, you might think, okay, well, maybe this is a good time to kind of exit. Don't kind of keep your losses forever and ever and ever, because it could mean that you're not getting the gains in other things. So again, this comes down to your decision making, but it can be very hard to accept that loss. Now, of course, this is more applicable to those of us who invest in individual stocks because these have a tendency to change more over time than like an ETF or an index fund, which are more broadly diversified. But equally, you can decide that this is no longer the right decision for you. But don't be afraid to sell if you think that there's enough evidence out there to say that this is no longer a bad investment and it no longer aligns with your values. Accept the loss and move on to the next one. The next and final one, to kind of illustrate this and to illustrate how the psychology can impact you as an investor, we're going to look at the Dow Jones and a graph of that leading up to the coronavirus market crash. So the Dow Jones, in case you're not aware, is the top 30 companies in America, the largest 30 companies in America. So if we look at this graph here, we can see in 2017 that the market's kind of going up. So it started down, it started to go up. At that point, if you're an investor, you might, if it's just like come down, you might be like thinking, oh, I'll sell because, you know, it might go even lower. And then as it rises, people start to, okay, there is a bit of confidence growing. This might be a good time to invest. I might put a bit more in, I might put a bit more in. As it steadily grows, then it kind of evens out a bit. and then it grows and people are growing in confidence the more that this goes on. People who maybe haven't put any money in up until this point are thinking, okay, well, you know, I'm not quite sure on this, it might still drop a bit more, but I think it might be a good time to invest. People start to tell their friends about it, you know, they start to communicate on forums, they speak to friends and family members, say, okay, well, this might be a good time to invest in the Dow Jones, you know, the bigger companies are starting to win, they're doing really, really well. And then as it gains momentum, you can see up to here to 2017 to 2018, you know, you get a bit of a fear of missing out factor as people kind of pile in. They think stocks only go up, it's going to be a great year, this is going to be the biggest bull run, just means,
you know, it's going to rise forever and ever and ever, my money's safe, I'm going to have a great investment.
And then it reaches the peak here, and then suddenly, boom, drop. And then you think, okay, well, maybe I should sell all my investments, like it's going to be a big crash, it's going to be horrendous, I'm going to lose a lot. And then you get the fear of missing out again, and the cycle kind of repeats. And this is particularly prevalent up until 2020, when you can see this absolutely massive drop here for when COVID hit. Now, ordinarily, you know, there is a catalyst to spark the drop, and in this case, it was COVID. So this kind of went all the way down here. And at that point, people all the way down are scared. They're thinking, oh my God, I'm going to lose my life savings. This is a huge correction. Should I get out right now, basically? And then as people go up again, basically here, it's don't believe the hype and stick to your strategy. The thing is with investing and with all of this stuff, it's so easy to get caught up into a short-term mindset, especially when there's such a massive drop like in here. Like if it drops, I'm not too sure how big that is in percentage terms, but I'd imagine it's a good, 20% or something. When it drops that much in percentage points, it can have a big psychological impact because you attach an emotional importance to that money, and it's something that you kind of have invested. It's equated to your time in work and effort and labor. And then you've put it into an investment expecting it to grow, and then suddenly, boom, it's dropped and you've lost some money. But don't let that concern you. If you're a long-term investor, then that's great. You know, just let it hold and use a strategy and stick to that strategy. So if you're dollar cost averaging, you're going to be absolutely fine. So if you're just putting money into the stock market on a regular basis over the long term, you're going to be fine. It becomes a bit of a danger though if you put in a lump sum. If you think, okay, well, you know, this is a great time to invest in what's that, like the end of kind of January, early February in 2020, you're like, oh, okay, this is a perfect time to invest. We've just had a big bull run. Stocks have gone up for ages. I should be safe to put in all my life savings here now. And then boom, suddenly it's dropped. And if you're inexperienced or if you don't know kind of the long-term aspect of the stock market, then it's going to have a big psychological impact. But over the long term, you don't have to worry too much in theory. I mean, obviously I'm no financial advisor, but fear of missing out is a huge one, especially for individual stocks. You see it going up and up and up and up and up, and you think, okay, well, now must be a good time to invest because it's going up, and I don't want to miss out on the gains that it's having. And then by the time that the hype has kind of grown, generally speaking, that's the time that you don't want to be investing in it, because as Warren Buffett said, be fearful when others are greedy and be greedy when others are fearful. So that's kind of the best philosophy, in my opinion, in terms of how to treat fear of missing out, because it can be very, very difficult. And I know I've certainly done it as well. You buy stock at the peak, as it peaks, because you don't want to miss out on the gains, and then suddenly it drops and you're thinking, oh my God, what have I just done? Because it might not ever reach that again. And that's the thing with individual stock investing, is that you just don't know. So I hope that that's been helpful. Which of these have you experienced before, if any? And are there any that I missed? Let me know down in the comments section below. I hope that this was useful, and I will see you in the next one.